90 miles. That's the distance between Cuba and the Florida coastline. I want you to think about that for a second. 90 miles. I can drive further than that on a Sunday afternoon just to get decent barbecue. And sitting right there, 90 miles from American soil, Cuba has just quietly stockpiled 300 military attack drones. Not hobby drones, not the things your nephew flies at Christmas. Military-grade systems built by Russia and Iran, with enough range to reach power grids, oil refineries, airports, and military bases across the southern United States. And here's the part that really got me. Wall Street has absolutely no idea what's coming. I've been around long enough to recognize this feeling. I felt it in the early 80s when nobody wanted to touch retail stocks and I was buying them hand over fist. I felt it in the 90s when people thought consumer companies were boring, and I thought they were gold mines. And I'm feeling it right now looking at counter-drone defense, because what we have here is a genuine threat that most investors aren't paying attention to yet. Sitting inside a sector where stocks have been beaten down 30 to 40%, and a government that historically responds to threats like this by opening the checkbook wide and not asking too many questions about the price tag, that gap between what's actually happening and what the market has figured out, that's where regular people make life-changing money. Not by being lucky, not by having some inside connection on Wall Street, just by paying attention earlier than everyone else. So today I want to walk you through exactly what I'm seeing, which 5 companies I'd be watching very closely right now, and maybe more importantly, what mistakes to avoid, because I've watched perfectly smart people destroy perfectly good opportunities by making the same avoidable errors over and over again for 40 years. Let me start with the facts on Cuba, because I want you to understand this isn't speculation. The CIA director recently visited Cuba personally to assess the situation on the ground. The U.S. military ran counter-drone defense exercises off the coast of Key West. Reuters covered it. Axios covered it. U.S. intelligence agencies have confirmed the core of it. 300 Russian and Iranian-built attack drones accumulated by Cuba with the operational range to threaten American infrastructure. The reason this matters beyond the obvious national security concern is that the United States is genuinely not prepared for this particular type of threat. And I say that not to be dramatic, but because it's simply true. Think about where American defense spending has gone for the past several decades. Jets, ballistic missiles, bombers, nuclear deterrence. The whole architecture of American military defense was built around Cold War-era threats from other superpowers with massive conventional militaries. Drones are a completely different problem. They fly low, they're small, they're inexpensive to produce, and the radar systems that were built decades ago to detect incoming aircraft genuinely struggle to pick them up. The United States has a hole in its air defense capability right at home, not somewhere overseas. And the people in Washington are starting to realize it. When governments realize they have a critical vulnerability on their own soil, they don't take their time about fixing it. They spend fast and a lot. I've watched this same pattern play out more times than I can count. After 2001, the Homeland Security budget exploded, and the companies making screening equipment and surveillance systems went from obscure to enormous, almost overnight. When cyber threats became a serious national conversation, cybersecurity firms that most people couldn't name became billion-dollar businesses in just a few years. When Russia went into Ukraine, defense contractors rallied sharply across Europe and America as governments scrambled to realize they'd been running down their own stockpiles for years. The sequence is always the same. Threat gets identified, government panics, checks get written, and the investors who did their homework before the panic hit, they're the ones smiling when the dust settles. Now, before I get into the specific companies, I want to make one thing very clear. I'm not sitting here hoping something bad happens. I never have operated that way, and I never will. But there's a difference between hoping for conflict and recognizing that a government is going to spend money to prevent it. America is going to build counter-drone defenses. That is not a question of if. It's a question of when and how fast. And the companies that make those systems are going to get paid. That's just the world as it actually is. So let's talk about the 5 companies I'd be watching. The first one is Axon Enterprise. And this might surprise you because when most people hear Axon, they think police body cameras and tasers. That's been their business for years. And honestly, it's a wonderful business. Police departments pay them month after month on subscription contracts. It's steady, recurring, predictable revenue. But here's what most people have completely missed. Axon quietly went out and acquired a counter-drone company called Troy de Drone. And that division didn't just grow, it exploded. 300% growth in a single year. Last quarter, they pulled in $100 million in counter-drone revenue alone, up 95% year over year. When I see a number like that, I sit up straight. because what you're actually getting with Axon is a 2-for-1. You get the stability and cash flow of a proven business that isn't going anywhere, no matter what happens geopolitically. And you get serious, already meaningful exposure to the fastest growing part of the whole counter-drone defense story. The stock isn't cheap, I'll be honest. You're paying a premium. But unlike some of the others in this space, you're not paying for a dream. You're paying for a business that is already generating real revenue from the exact problem Washington is about to throw a lot of money at solving. The second company is Kratos Defense and Security Solutions. Now, this one is more aggressive, and I want you to know that going in, Kratos builds unmanned aerial systems. They have a program called Loyal Wingman Drones. Unmanned aircraft designed to fly alongside manned military planes, extend their range, absorb risk, and do dangerous work. They're also developing hypersonic weapon systems. They've got $2 billion in backlog, meaning contracts already won, work already committed, revenue that's coming in regardless of what the stock does tomorrow. The underlying business is actually doing quite well. Sales are growing, margins holding, cash flow improving, and yet the stock is down around 60% from its highs, 60%, while the business itself is getting stronger. So I've seen that kind of disconnect before, and what it usually means is one of two things. Either the market knows something genuinely bad about the business that the numbers haven't caught up to yet, or the market overcorrects on the way down after overcorrecting on the way up. Based on everything I can see in Kratos' actual financials, I think it's the second one, but I'm not telling you to run out and buy it this afternoon. What I'm telling you is that this is a company worth understanding deeply right now so that when the momentum starts shifting, you're not scrambling to learn about it under pressure. The third company is L3Harris Technologies. These are the people who build the electronic warfare systems, the sensors, the detection equipment that tells you a drone is coming before it ever gets close enough to cause damage. And I want you to think about that for a moment because I think it's actually the most important piece of the whole counter-drone picture. Shooting down a drone after it's already close is one solution. Knowing it's airborne while it's still far away is a much better solution. L3Harris makes the eyes and ears of modern air defense. They're generating about $5.5 billion in revenue. Every quarter, their margins are improving. The business quarter over quarter is genuinely getting healthier. And the stock pulled back hard after the Ukraine-related run-up as the market rotated out of defense and into other things. Right now, it looks like it's catching its breath, consolidating, figuring out where it wants to go next. I'm not in a rush here, but I think in the coming months, as the Cuba situation gets more attention and more defense dollars start flowing toward domestic air defense specifically, L3Harris is going to be in a very interesting position. The fourth company is Red Cat Holdings, and this is where I need to be completely straight with you about what you're buying. Red Cat is tiny, less than $1 billion market cap. They make small unmanned drones, and they're on the Pentagon's approved Blue UAS list, which is essentially the government's stamp of approval saying these products meet our security requirements and we can procure them without restrictions. Now, I always believe that small companies can become big companies, but big companies can never become small companies again. The potential upside in a small, specifically approved, government-eligible drone manufacturer sitting inside a sector about to receive a surge of federal spending is genuinely significant. But so is the risk. This company is not profitable right now. The numbers today are not impressive. What you're making a bet on is the future, on contracts materializing, on spending accelerating, on this small company being in exactly the right place at exactly the right moment. When they've won major contracts before, the stock has doubled and tripled in very short periods of time. It could do that again. It could also go to zero. Both outcomes are real possibilities, and anyone who tells you otherwise is selling you something. So if you have the temperament for it and you can genuinely afford to lose what you put in without it affecting your life, Red Cat is worth a small position and close attention. If that description doesn't fit you, there is absolutely no shame in skipping this one entirely. The fifth is not a single stock, but an ETF called XR, the SPDR S&P Aerospace and Defense ETF. And the reason I like it comes down to how it's constructed. Most defense ETFs are market cap weighted, which means they put most of your money into the biggest companies. Lockheed Martin, Raytheon, Boeing, great companies. But here's the problem. If counter-drone revenue represents 2% of Lockheed Martin's total business, and it doubles, that barely registers in their stock price. XR holds about 41 companies at roughly equal weights. That means the smaller specialized players actually get meaningful representation. When a specific theme catches fire, those smaller companies are the ones that move the most, and XR actually captures that. It's been up around 50% over the past year while sitting quietly, doing essentially nothing since the start of this year. That kind of consolidation after a strong run in a fund with real underlying momentum. That's often exactly the setup I like to see before the next leg higher. Now I want to spend some time on mistakes because in my experience, this is genuinely more valuable than any stock tip I could ever give you. The investments that have hurt people most over the years were not cases of bad companies. They were cases of good companies bought the wrong way or at the wrong time by people who didn't have a clear framework. The single biggest mistake I see is buying on headlines. And I know that sounds obvious, but you would be amazed how many smart people do this repeatedly when the Cuba drone story finally breaks wide open in mainstream news. And it will. That moment will feel like the perfect time to buy defense stocks. The news will be scary, the urgency will be real, and everyone will be talking about it. But that is almost certainly the worst moment to be buying. The institutional money, the people who read intelligence briefings and track procurement patterns and notice when defense companies start getting unusual visitor traffic from government officials, those people are already moving. By the time it's on the front page, they'll be looking for someone to sell their shares to. And that someone, historically, is the retail investor who just saw the headline and got excited. So, I watched this happen after the Gulf War. I watched it happen after 2001. Buy before the crowd discovers it, or accept that you missed this particular opportunity and wait for the next one. The second mistake is getting seduced by leverage. There is a leveraged defense ETF called DFN that promises 3 times the returns of the sector. It sounds incredible. It is actually down this year while the regular defense ETF is up. How is that possible? It's called path decay. Leveraged products reset their positions daily, and in a sector that moves up and down with volatility, that daily resetting slowly bleeds your investment even when the underlying sector is trending upward over time. These products are built for traders who hold them for hours or maybe days. They're not built for investors building positions in a theme they believe in. If you use leverage here, you are fighting against the mechanics of the product itself, and the product will win. The third mistake is ignoring what you're actually paying. Some counter-drone companies are trading at price-to-earnings ratios above 100 right now. You're paying $100 for every single dollar of annual profit. That pricing assumes everything goes perfectly for years in a row with no hiccups, no competition, no delays in government contracts, no political changes in spending priorities. In the real world, things are never perfect. They never have been. If growth slows even slightly at those valuations, the stock doesn't just pull back a little, it falls off a cliff. Meanwhile, there are companies in this exact same space trading at genuinely reasonable valuations because they got caught up in the broad sector sell-off, even though their businesses are actually quite strong. Knowing the difference between those two groups is the whole game. The fourth mistake is buying indirect exposure when you can get direct exposure. Palantir comes up a lot in conversations about defense and AI and military technology. It's a genuinely impressive business, and I have a lot of respect for what they've built. But Palantir is a $300 billion company. Counter-drone contracts are not going to move the needle for a $300 billion company in a way that moves the stock meaningfully. If you want to invest in counter-drone defense, invest in companies where counter-drone defense represents a significant portion of what they actually do. Companies where a major new contract changes the whole picture. That's where the real upside lives. Here's the broader thing I want to leave you with. In 40 years of looking at businesses, I've learned that the market is usually pretty good at pricing things that are already widely understood. Where it consistently struggles is with things that are new, things that are changing fast, and things that most investors aren't paying attention to yet. Counter-drone defense in America in 2025 fits all 3 of those descriptions. It's new, it's moving fast, and most investors right now today are not paying attention to it. That combination has historically been one of the best environments for finding investments that genuinely change your portfolio's trajectory over the following few years. I'm not telling you to bet everything on this. Please don't do that. The right allocation for something like this is probably 1 to 5% of your overall portfolio, depending on your situation, your age, your other investments, your income, your ability to sit through volatility without making panic decisions. Small enough that if I'm completely wrong about all of it, you've had a bad quarter. Not a life crisis. Large enough that if things develop the way I think they might, you genuinely feel it in a meaningful way. What I'm telling you is that the setup here is as clear as anything I've seen in a long time. A real identifiable threat, a government that will spend money to address it, a sector that's been beaten down and is not priced for good news, and a handful of companies directly in the path of where that spending is going to land. Do the work. Understand the businesses, size your position sensibly, and then be patient. Because the market comes around eventually, it always has, and the people who did their homework before the crowd arrived are always the ones who look back at moments like this And say that's when things change for me. That's been the whole game my entire career. It still is.